Hi, this is Keith Schneider, CEO of MarketCage.com, and this is February 9th edition of Market Outlook. Well, we have a lot to cover, so we're going to get right into it. Lots of volatility this week and leaves the markets in interesting positions all around. Some interesting developments in emerging markets as well. So we're going to get to that at the end of this broadcast. So first, let's take a look at the spiders. As you can see, the spiders trading in sort of this broadening channel formation. However, as we attacked the 50-day moving average, traded under it really sharply, we got that really steep sell-off, and then of course the reversal pattern over the last couple of days. But we got really oversold in terms of price momentum, bounced back on a slingshot pattern here, an inside day, another test on Wednesday, and a resounding rally that was pretty good. Although volume relative to the sell-off, a little bit light, but still on greater than normal volume. What is of concern in the S&P, we're actually getting a deterioration in the 50-day moving average, but not so bad that if we get a sustained rally, we can't actually turn this thing around. Now, pretty good size resistance is going to come in right around that 50-day moving average, which comes in at about 181 or so, and there's some pretty good resistance. In fact, this downside day here and the 50-day moving average is sort of a zone of resistance. That's what we want to watch, that this rally here peters out around that resistance level. Again, not fully overbought there, so still some room to move on the upside. But as you can see, trading at the upper range of this channel here definitely has given the S&P a reason for pause. Completely different scenario in NASDAQ. In NASDAQ, we've already closed above the 50-day moving average and really is just a hair away from record highs. Now, this index, not quite as broad. It's only the biggest 100 NASDAQ stocks, but it is tech laden, and that's pointing to technology and healthcare stocks leading the rally up here. So again, NASDAQ 100 definitely in much better shape. One of the tells are going to be if we can take out the recent highs, then you can really say that the overall market direction is going to get pulled up and sustain and move back into what type of market scenario we had in 2013. Let's take a look at the VIX. Well, bit of a panic. We moved from 40 all the way up to 55. That's a, I don't know, 30, almost 40% move, 35% move. And as you see, when we got to the outer end of the Bollinger Band, moved back in, it moved violently back in, and that was a trigger for a buy signal confirming the price action in all the key indices. Now, what's happening here, though, is we are trading still above the 50-day moving average. To really go into full-blown bull mode on this particular indicator, we really want to see you trading under the 50. So I would say right now you sort of mix between a reversal of a Bollinger Band buy signal for the market that's now been contained by the 50-day moving average. So I give that one an overall neutral. What's more interesting is how well the market responded off the oversold condition. McClellan oscillator intermediate definitely bouncing off the lows, generating a buy signal. Now what's really nice in here is that on the shorter term advanced decline and up down volume, our more 1 week to 2 week indication here is that we are on a confirmed buy signal, where both the move back up above our demarcation of an oversold condition was confirmed by both the advanced declines and up down volume. That's one for the bullish scenario. Okay, so overall, you can see that we are definitely have more indications overall of a more positive environment and possible some continuation and follow through. Let's take a look at the bonds. Bonds, TLTs, as you know, we had pointed this out early in the year. We sort of got this pause here, a bottom, slingshot bottom on the on the daily charts. Now, if you look at the monthly, even more interesting. Monthly bond chart got a key reversal right at the long-term, super long-term bullish monthly moving averages. This is an 80-month. You can see we tried to close under it for a month. We did, but really couldn't get any momentum to the downside, and the markets here, this particular market has reversed. So again, we're holding the fast monthly moving average, which is still fairly important, and that's holding nicely in here. So overall, looks like some bottoming action in bonds, which would confirm and be in conjunction with continued strength in the overall market. Now, let's take a look at GLD, gold. Also interesting. Very similar scenario. The very long-term trend defined by the 80 monthly, basically the double bottom from the big sell-off mid part of last year could not be taken out. We're trading back at around that 80 monthly moving average, and it's holding. So one of the things that's interesting here is you got this bottoming formation. We also, as you can see, took out this key trend line here, and if we can get above the highs of last week, you would basically, this pivot area or this pivot zone, which is around the 122 area, if we can get above there, I would say that a intermediate term bottom is in place. We've already taken out the trend line, but we really need to see this sort of basing pattern and compression area move up. Now remember, one thing we're doing quite the opposite of what the S&P is doing in terms of direction. We definitely held the lows in the beginning of the year, bounced off of it, and has been compressing at a higher level. The key area to watch here is just under the 50-day moving average and this lower end of the Bollinger Band. So if we fail this particular pattern here, could be another test of the lows. Meanwhile, it looks like a potential bottom is in place. It also looks like it's being confirmed as well on the gold miners, which are actually doing a little bit better because they're closer to the declining 200-day moving average. And as you can see, lots of compression. So watch GDX, the gold miners. If we can get above the 24 level, certainly get an attack above here. And again, this looks like a potential bottoming formation in GDX as well. Now, in terms of some of the calendar ranges, let's take a look at where some resistance may come in on the spiders relative to the calendar range. These heavy lines here are the 2-week January calendar range. Interestingly enough, I had pointed out that level of resistance on the 50-day moving average on the other SPY chart. But we also, that coincides perfectly with the calendar range. So the key area we really want to watch is the 181.30 to 50 level, which would then breach both the 50-day and the calendar range on spiders. In terms of emerging markets, EWW, this is, well, actually, let's go to EEM, which is the emerging markets. And you can see we definitely have a bottoming pattern in here. And while the market, the U.S. equities market was selling off, this was sort of outperforming during that period. Not by much, but by a little bit. But it could mean a potential firming overall in the smaller markets, the emerging markets as well. The other thing of interest was also Mexico, which bounced off its 80 monthly, the 200 weekly moving average as well, while it is also got pretty bombed out here. Look at this. You can see the lows that were put in late summer were breached and rejected. So very possible bounce back up to the 65, 66 level, which would be a 5-6% rally for Mexico, and it's something to watch here. But interesting patterns in those emerging markets. Now I'm going to cover one other thing is the spread chart. This is a spread ratio analysis. The lower chart here is a moving average of the ratio between the underlying instrument. In this case, it's TLTs and spiders. So as you can see, on a daily basis, the bonds were clearly outperforming early part of January, the S&P. As you can see, we moved above this moving average here and have been trading above it all of 2014 so far. Also to take note, the TLTs on a weekly basis also has been trading above its longer-term spread chart, which is the weeklies. Obviously, bonds still on a longer-term basis over here, which is an annual or actually a 65-week moving average, still is in a bearish mode relative to the S&P. But overall, it looks like interest rates need to hold pretty much right around these levels to continue its bull move relative to the S&P. But it really should be holding this level and keep this uptrend intact. Now, in terms of the emerging markets doing the same type of analysis, what I thought was interesting is you can see that on a weekly, this is a quarterly ratio, and this is an annual one, very bombed out. But what is interesting here in the emerging markets is we're starting to attack this monthly moving average right here, and it's starting and has sort of outperformed just in the last couple of days the U.S. equity markets. So let's keep an eye out on some of the more bombed out other countries and regions of the world. That's it for now. Hope you enjoyed this. See you next week, and happy trading.